So before we get started, check out the following links in the description box below as highlighted in the image shown. So you'll be able to get our past papers, our link to our official website, link to accreditations, our link to donation page, and contact details in the description. So once you'll be watching a certain video of any lesson or of any past paper, you'll be able to get all these links, and you can be able to get to download past papers, to reach to our official website. You'll be able to see links to our accreditations so that you can see which authorities have accredited us. You'll be able to reach to our donation page as well as our contact details.
So welcome class back. So we'll proceed from where we have stopped. This is the third part. So question 31, what is the economic entity principle? What is the economic entity principle? An accounting principle that requires an entity to disclose all material items that are likely to affect decision making. This is not the entity principle. This is the materiality principle. The materiality principle of materiality, where you are supposed to disclose all material items. An accounting principle that requires an entity to treat similar items the same way in different period. This is consistency. This is consistency, so definitely it's not the economic entity. Then an accounting principle that states that a business finance should be kept separate from those of the owner. Yes, this is the economic entity or business entity principle. We talk of business entity principle or economic entity principle. It's an accounting principle that says that a business finance should be kept separate from those of the owner. The owner is and the business, two different entities. Let's look at the fourth item, what the fourth item presents, and then we can come to a conclusion that the entity principle is an accounting principle. Is an accounting principle that requires an entity to take the figure which will understate rather than overstate the profit. No, this is prudence. This is prudence. So definitely the answer is C. So we go with C as being the correct answer. Thank you. So let's move to the fourth part. Okay, it's not deleting, but it's okay. Okay, so the correct answer is C. That is the economic entity or business entity principle. That the business is totally different, distinct, and independent from the owner of the business. Use the information below to answer question 32, 33, and 34. Now, John Mutembei commenced transportation business on 1st January 2022. On that date, he purchased a motor vehicle for 3.9. So 1st January, allow me to write here, Jan 2022, he purchased vehicle at 3.9. On 1st January 2023, 1st Jan 2023, he purchased another motor vehicle at 5.2, so 5,200. John Mutembei provides for depreciation at the rate of 25% per annum on straight line method. 25% per annum. This is a straightforward question. So if we go with this 25%, you are supposed to prepare the schedule, depreciation schedule. But the simplest, this is a very simple question, so let's just go straight forward. 25% of 39. This is depreciation for 2020. 2022, depreciation will be 25%. So just do 0.25 times what? 39. What do you get? 975. So depreciation for 2022 is 975. And then depreciation for 2023, again at 25%. Why 25%? Because John Mutembei provides for depreciation at the rate of 25% per annum on straight line method, not reducing balance method. If it were reducing balance method, then we'll be calculating based on the balance brought down. So you take the original figure, less depreciation, the remaining balance, you work on it like that. But since it's on a straight line method, we just get the percentage of the original cost, and that is what will be used as depreciation on all the succeeding or successive years. So this means that also in 2023, the same vehicle depreciated by 975 shillings. So if we go by this, at the end of 2022, what will be the value of the vehicle? It will be 3,900, 39 minus 975. So that is 2925. This will be the value of the vehicle as at end of 2022. As at end of 2023, it will be 2925 minus 975. This will give us 1950. So this is the value of this vehicle as at end 2023. And 2022 is this, 2023 is this. That is after we factored in the depreciations. Then for this vehicle that was bought in January 2023, at the end of the year, it will have depreciated by 25%. So 25% of 5.2 is 1,300. Just work 0.25 times 5.2. You will get 1,300. So at the end of the year, the value of this vehicle will be 3,900, if I'm not wrong. That is 5,200 minus 1,300. That should be able to give you that figure that I've just talked about, 3,900. That's it. So let's look at, let's go back to the question and see if we can answer it. Sorry for that. So the question is, calculate the net book value of motor vehicle at the end of 2023. Calculate the net book value of motor vehicle at the end of 2023. This is so easy. Calculate the net book value of motor vehicle. So net book value of vehicle A as end of 2023 is this 1950. And then for vehicle B as at end of 2023 will be this figure here, which is 3,900. So the total is 900 plus 1950. That will give us the answer, 5850. So 5850 is the net book value of the motor vehicles. Do you have it here? Yes. So the answer is D. We are done with that part. Calculate the accumulated depreciation at the end of year 2023. Calculate the accumulated depreciation, the total depreciation. So the total depreciation will be this one. Depreciation for 2022 plus depreciation for 2023 for vehicle A and depreciation for 2023 for vehicle B, which was only existent in that year. So this will give us 975 plus 975 plus 1,300. Just that. The answer is 3,250. 975 plus 975 plus 1,300 should give us 3,250. Do we have that in the here? Yes, 3,250 have it. That is the answer. That is the accumulated depreciation at the end of year 2023 for both the two vehicles. Calculate depreciation charge for year 2023. Year 2023 will simply be 975 for vehicle A plus 1,300 for vehicle B. This one will give us 2,275. That is the figure of depreciation. We have it here. So answer A. A will be the answer. So thank you. Let's move on. Use the following information to answer question 35, 36, and 37. Anthony, Brandon, and Cesar trade as partners, sharing profit and losses in the ratio 2:1, respectively. Interest on capital is allowed at 5%. No interest on drawings. Brandon is entitled a salary of 200,000 per annum. The partnership statement of financial position is as at 30th September 2022 is as follows. So we have assets, so of course those ones, liabilities, like that, additional information. On 30th September 2023, closing inventory was valued at 7350. While trade payables, trade receivables, and cash balances are 950, 400, and 350 respectively. Cash drawings, we have it. In addition to which Caesar took goods worth 850,000. Depreciation is to be charged at 12% per annum on furniture and fittings. Purchases and sales, those figures. Wages, salaries, electricity, general expenses. And you are supposed to calculate the net profit or loss for the partnership. Net profit or loss. Let's bounce into it. I will just use this space here. Forgive me for that. So we go to sales. Sales, I think we have the figure sales here, the figure for sales. Purchases and sales were 13, item number 4, under additional information. This one. Purchases and sales were 13,981 and 13,639 respectively. So sales will be the latter one. So 13,639.4, that will be our sales. Then we less opening stock. So do we have opening stock? This is on September 2023. You can follow my cursor, but the information you have here is for the partnership. This is 30th September 2022. So it means this information will form part of the beginning balances. And the book we are preparing is for 2023. So this is the opening balance. So let's just take the inventory. This inventory means that this is the opening balance. How much is it? 4150. So we're going to pick that as the opening stock. Opening stock 4150. Then we add purchases. Do we have purchases? Of course, yes. Of course, purchases are here. 13,981.4. That is our purchases. Do we have and before we go to closing stock, there's something about these purchases that is very important. Caesar took goods worth 850,000, so we need to reduce this. We need to reduce this from the purchases. Caesar took goods worth 850,000, so let's reduce that from the purchases. Very important. We reduce that from the purchases, so that we don't count it among the goods. So we'll less the purchases by that, and then we'll less the closing. We'll less closing stock, and we've also been given the closing stock, I think somewhere here. Yeah, on 30th September closing inventory was 7350. 7350. So 7350, like that. So whatever I get here will be our cost of goods, cost of sales. So this is for 150 plus 13. Sorry for the noise. Plus 13, 981.4 minus 850 minus 7350. That gives us 9931.4. So when we less this from that, minus 136.39.4, it gives us 3708. This will be our gross profit. Our gross profit for this business. So then let's move on. Having gotten that one, 3708. Move on to the expenses. Let's see if we have additional information, additional income. So straight we bounce to the expenses. Depreciation to be charged at 12% on furniture and fittings at cost. So cost for furniture and fittings is 1.7. So 1700 times 0.12, that gives us 204. 204. So depreciation have 204. Wages and salaries paid to partner, including salary paid to the partner. Now this salary paid to the partner, we have to remove it from here. Salaries paid to the partner, it's not part of the, that one will come later and it will affect their current accounts. So it will come in the appropriation account. So let's get rid of it from the profit and loss account, because he's one of the owners. So it will be 1450 minus what was paid to the partners. Let's get what was paid to the partners. It's here. Brandon is entitled a salary of 200,000 per annum, and this is, we are talking about salaries per annum, wages and salaries. Okay, so it will be 1450 minus 200, which will mean that our wages and salaries will be a total of 1250. Then electricity 40, then general expenses 102. Remember, we are holding the zeros, so 102. Is there any other expense? Check around, check if we have any other expense before we can just wind up on this. We don't have any other, so we add this. This will be 204 plus 1250 plus 40, 102 plus 40. That gives us 1596. So we less 1596 minus that 708. This gives us 2112. So this will be our net profit from the business. I hope that's what the question is asking. Calculate the net profit or loss for the partnership. Yeah. This is the answer, 2112. That is the net profit for the business. That is the net profit for the business. Thank you. Next, and that's how we get it. Calculate the profit shared among the partners. Profit shared among the partners. Now, profit shared among the partners, we need to proceed with this so that we got the appropriation account. So let's see what is contained in the appropriation account. In the appropriation account, if we have interest on drawings, we add, because it's the partners who will be paying the business. If we have interest on capital, we less, because it means that the business will be paying the partners. So partner salary will also come at this point. So anything that affects partners directly will come in the appropriation account. So Anthony, Brandon, and Cesar trade as partners, sharing profit in the ratio 2 to 1:1. Interest on capital is allowed at 5%. Aha, there we go. Interest on capital is allowed at 5%. So 5% of whatever capital they have put in the business. And this will be an expense to the business because the business that is paying them. So we are going to reduce the net profit by these figures. So 5% of what they have invested in the business. And I can see Anthony 3,000, Brandon 1,500, Cesar 1,500. So 5% of each of this. And normally we start with additions. Do you have any additions? So far we don't have any additions. So we'll just less. So go to appropriation account. We say interest on capital. So we have 5% of A, B, and C. 5% of A was 300,000, 3 million. Yeah. So 5% is 0.05 times 3,000. That gives us 150. B will give us 75 because it's 1.5. So the total this is 300. Then we also have partner salary. It will also feature here in the appropriation account, which is 200. And all of this will give us a total of 500. My arrangement is a bit awkward off. Let me just repeat this. So this will be 150, 75, 75. The total will be 300. And then partner salary is 200. When you add all this, we have 500. We less from that, from the 2112. And what we are going to get is it 1612? Yes, 1612. So this will be the profit that will be distributed amongst the partners. Now that's not where we're going to write. The 1612 will put it somewhere here, 1612, and then we say partners profit and loss distribution. So we have A, B, and C. A will take 2 over 4, because the profit distribution is 2 to 1 to 1. So it means partner A will take 2 over 4, partner B will take 1 over 4, and partner C will take 1 over 4. That's how they are going to distribute the profits. So let's distribute the profits. We see how they will go. Partner A, 2 over 4 of this. This is half of this. 2 over 4 is just half of this. So that will be 806. And then 1 over 4 a quarter is 403 and 403. So if you add this, it gives you the 1612, which will now give us basically 0. It will have shown how they are going to distribute the profits. So this is how the profit will be used. Net profit is 2112. Interest on capital, this one will be used to pay the partners. Salary will also come at this point, and then the rest will be shared among the partners in their profit and loss sharing ratio, and this is how they are going to share. So what was the question? Let's go back to the question. Calculate the profit shared among the partners. Profit shared among the partners is 1612. This one, 1612. That is the profit shared among the partners. So do you have it? Yeah, there we go. Then calculate the share of profit to each partner. Share of profit to each partner. We've said how they are going to share 806, 43, and 43. There we go. 806, 43, and 43. So B is the answer. So let's continue. The following information was provided by Sele Traders. Oh, these are different questions altogether. So allow me to delete this. Allow me to delete this so that we can use this space for other. Yes, that one is already done, so let's do away with it. Okay, let's proceed. The following information was provided by Sele Traders. Carriage in was 150, purchases 3.2, gross profit margin 25%, gross profit 1250. Determine the total sales. This is quite easy. Sales is equals to, okay. The easiest way to get this, based on the information that we've been given, is to go the ratio way. I bet that will be the easiest way and most direct, so that we take the least time possible. We have this ratio, gross profit margin, because we've been given, is equals to, normally it's sales of gross profit margin. Gross profit margin is equals to gross profit over sales times 100. Yeah, that's the formula. So if that's the formula, we've been given gross profit, we've not been given the sales, but we've been given the gross profit margin. The only one unknown, so this is the easiest way to go. So gross profit margin is 25%. Can call it 0. Okay, let's just call it 25. Let's just work with 25. 25 is equals to GP over sales. Oh, sales, we have sales. Oh, it's the GP that we have. So there's no need of me repeating here again GP, because we've already, let's just do away with this GP thing. So 25 is equals to GP. This is 1250 over sales. So sales is unknown, times 100. Yeah, that's pretty okay. So times sales times sales. So of course this sales goes with this sales. So do you have, we have 25 sales, and sales can be X, is equals to 1250 00. I think we are okay. So divide by 25, divide by 25, so that we can get the sales. Yeah, that is well in order. So sales is equals to, it will be 1250 00 divided by 25. That gives us 5,000. So sales is equals to 5,000. But remember, we have restricted how many zeros? 3 zeros. So sales is the same as 5 million. Sales will be 5 million. Do we have that answer? Yes, we have the answer here. Sales is equals to 5 million. There we go. We are done. Yeah, the rest now. Somebody might ask why we are not using carriage inwards and purchases. They are not important in the formula, and the formula is straightforward. It has one unknown, which we've already found out. So there's no need to go into a lot of other details. So then let's move on. And by the way, you can also work like carriage inwards, purchases, sales minus carriage. But that one may not give you the correct answer because we don't have closing stock, we don't have opening stock. I think let's just stick to the gross margin way, what we have just worked with. So that's the correct answer. Which of the following is not a limitation of financial accounting? Inadequate information to determine the price of products manufactured. Yeah, that is definitely correct. That is a limitation of financial accounting. Lack of data for comparison of cost of operation of the firm with other firms in the industry. Pretty good. The data available is historic in nature. Yes, all those are limitations of financial accounting. Complies with the various legal requirements. That cannot be a limitation. It's actually something that is good. If financial accounting complies with various legal requirements, then something that is commendable, something that is good. So that is not a limitation. That is not a limitation. So the answer is D. Which of the following is not a limitation? D is not a limitation. That financial accounting complies with the various legal requirements. That is not a limitation. In fact, it's a good thing. So it is not a limitation, and that's what the question is asking. So the answer is D. And lastly, the payment of wages to employees was not recorded in Fatuma's enterprise books. What type of error is this? The payment of wages to employees was not recorded in Fatuma's enterprises books. What type of error is this? A, error of omission. Perfectly well. The payment of wages to employees was not recorded. So it's an error of omission. So the answer is A already. But let's move on. Error of commission. No. Error of commission occurs when instead of debiting an account of one of the debtors, you debit on the account of the other debtor. For example, if you have P. Onyango and A. Onyango, instead of debiting P. Onyango, you debit A. Onyango. That's an error of commission. Error of principle. Very good example is instead of debiting machinery account or motor vehicle account, or let's start again. Instead of debiting motor vehicle expenses account, you debit motor vehicle account. That's an error of principle. An expense has been recorded as an asset. That becomes an error of principle, or an asset being recorded as an expense. That's an error of principle. So, of course, that is not what we are talking about. Reversal entries, where you debit a credit entry or you credit a debit entry. So, the payment of wages to employees was not recorded. This is definitely an error of omission. So the correct answer is A. The correct answer is A, error of omission. Yeah, we stop there. I think that is the end of that part 4 of this paper. Let's meet again in the next item when we'll be looking at the part 5, which is the last part of this paper. Thank you. Be blessed. Let me continue having my coffee. And please enroll to our classes. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions. And also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.